The worst is yet to come. I'm your host, Steve Van Metre, and thanks for joining me today. And in our lead story, the managing director, Kristalina Georgina of the International Monetary Fund, is predicting a dire outcome for 2023. Now, as a fan of this show, you know that we don't buy into what policymakers say because oftentimes they are wrong and not by a little bit. And what she's predicting is that 1/3 of all countries this year will be in a recession. And what that means, if she's wrong, it's going to be much worse. Let's head over where we picked this story up with IMF head warns of third of world in a recession this year. Now, this was done as an interview, so let's take a look here because I want to take you around the world and give us kind of that global view. And let's start in China. Of course, you know we've talked about China a lot. China's been in this hub of cheap manufacturing for the world, and we're also dependent on it right now, but it looks like COVID cases are exploding. And what does this mean for the global economy long-term and short-term? And Georgieva says in the short term, it's bad news as China slowed down dramatically in 2022 because of this tight COVID zero policy. And get this, for the first time in 40 years, China's growth in 2022 is likely to be at or below global growth. And that has never happened before. And so when looking over the next year or 3 or 4, it's going to mean bad news for the economy because China is such an important factor here. I mean, you're talking the second largest economy. So if they're slowing down, and remember, just internally, they drive a massive amount of consumption. So them slowing alone could push the world into recession, let alone 3 countries. You could talk about the rest of the world here, but let's continue on and see where they're going. Because this is the second largest economy in the world, and we learn how dependent the world is on the Chinese supply chain, and it's not just that. So do you expect a domino effect is the question. And would inflation get worse because all of a sudden there aren't workers healthy enough to go to factories in China? And while Georgieva says we expect that there would be a counterweight from the sheer opening of the economy because of now the biggest impact on the global value chains came from restrictions due to COVID. China is going to gradually move to a higher level of economic performance and finish the year better off than it did to start the year. But check this out. But you're absolutely right. The world has relied on China's growth for a long, long time. Before COVID, China would deliver 34, 35, 40% of global growth. So now you think about that and put that in context. If you are going to slow down, say, anywhere between 35 and 40% of growth, take it a business and say, hey, 1/3 of your business is going to slow. It's going to have an impact on all other parts of your operations. So you think about this from now a global economic situation. You have the second world's largest power generating over 1/3 of economic output. They're going to slow, and the rest of the world, well, we're going to feel it in a big way. And when I talk to Asian leaders, she adds, all of us start with this question, what is going to happen with China? Is it going to return to a higher level of growth? Well, that's a good question. And right now we say that it's probably not going to happen because out of Nikkei Asia today, they're warning that demand for Apple products is continuing to slide as Apple has alerted us to lower orders, get this, for all product lines actually since the quarter ending December, partially because the demand is not that strong. So here we have a case where it's not just an issue of, well, we're having a slowdown because we can't get things built. We're having a slowdown because demand is coming down. And of course, we knew this was likely to happen. Without fiscal and monetary stimulus driving the global economy, it was naturally likely to slow down. The only question will remain is how fast or will it grind to a halt? The next question they asked is, have you tried to separate the U.S. from China, as we've addressed on several shows recently? You separate them, there's an excessive cost, Georgieva says. So logic would be for where security reasons, there has to be a careful recalibration of supply chains. Do it, but don't go beyond. Don't go into benign areas of products that have no strategic significance, but they benefit the U.S. consumer. They benefit the world economy. This is what we're arguing for. don't go in a direction in which this separation would make everybody poorer and the world less secure. Now, what does she mean by less secure? Now, you think about, you take an economy, and of course, as long as people are working and productive and feeling like they can maybe get ahead over time, well, that's actually good. But if you take that away, well, what do you start to see rise up in power over if we look at history? Well, that's the war machine. So I think what we're hearing from the IMF here is say, look, we understand that for security reasons, in terms of your chip manufacturing from some of your high-tech stuff, that you do need to create separation. But don't pull out of China, because if they get desperate, well, you don't know what they're going to do. But are you predicting inflation to slow down to 6.5% from about 7%? Is that right? Well, Georgieva says, well, towards the end of the year, we project it would go even further down toward the end of 2023, making the case that interest rates are also headed lower, provided central banks stay the course. Our big worry is that with the economy slowing down globally, we are projecting global growth to go down to 2.7%, maybe even lower next year. And of course, with everyone believing interest rates to go higher, the actual case is we see rates go lower, and of course, inflation with that. And let's take a look and see, is her prediction that inflation is going to go much lower correct? Well, the charts say it will. Here we have the consumer price index in blue on a year-over-year rate of change against the 10-year 3-month yield curve. And what do we note? That in periods where the yield curve inverts below this black line and then rises, you get a steepener, then inflation comes down. And sure enough, you see again in late 90s going into the dot-com bubble, the yield curve steepened, inflation came down. You see it going into the great financial crisis again. This time the yield curve rising, inflation went up a bit, but look at that, came crashing down into deflation. Again, happened going into the pandemic. Yield curves was steepening even as inflation was coming down, and boy, it did. Here we have the case again, one of the steepest inversion now since 1980, or very close if we look at the 210s, but now matching that back to the dot-com bubble. And here's some data today. What do we see? German inflation plunged more than expected. Now, this is perhaps due to seasonality in their monthly series, but get this, if you start to see a repeat of what's going on in Germany and then into other countries where it's not just a one-off month, because it's going to take a lot more than a 1-month drop to get inflation to come down. Now, I want to talk to you something we got really right here, and that was our call on gold to our pro subscribers. So as you hit into the new year, 2 weeks ago, we told them, hey, you need to take a look and buy gold. It's breaking out. If you've been waiting to sign up, here you can see Momentum Timer Pro is right now half off for the next 100 people that sign up. And again, it's got a 30-day money-back guarantee, so you can try it out. Not only do we have the momentum screens across here, but we mention it. And then right now, still as we wait for the programmer to finish the new coding, we see gold on the CTA-Timer Pro, max long by the machines. Again, all of this 30-day money-back guarantee. Links in the description. Give it a try. Again, next 100 people for Markets Insider Pro, which includes Momentum Timer Pro, half off. Now let's keep back to our story here, because it gets even worse. One of your IMF researchers gave a pretty dire prediction, and overall this year, shocks will reopen economic wounds that were only partially healed in the post-pandemic, something we've been arguing for. And Georgieva says, for most of the world economy, this is going to be a tough year, tougher than the year we leave behind. Why? Because the three big economies, US, EU, and China, are all slowing down simultaneously, but they think, get this, that the US is resilient from a recession. You know, I don't think that. What do you think? Are we immune here? And when we look at the emerging markets and developing economies there, the picture is even dire. Why? Because on top of everything else, they get hit by high interest rates and by the appreciation of the dollar. For those economies that have high levels of that, this is devastation, and something we've talked about. When there isn't enough dollars in the global economy to pay on the debt, things start to break. And look where they go with that conversation. And just to explain for some of our listeners, a strong dollar, again, the case we have said is the problem, is good for Americans, but it's not good for poorer countries that have taken out loans. Exactly, bingo, they nailed it. For example, and borrowed money in dollars. According to the IMF, 60% of low-income countries are in distress because of this. Georgieva says, Well, so far, countries that are in distress are not systemically significant. Now, don't you enjoy that? Hey, yeah, we know they're probably going to default, but hey, nobody really cares. Well, that's the problem, is because you tip one domino and it knocks another one down and another one down. If it starts to pick up momentum, you can get a wave of these. And yes, one may not cause a systemic defaults, but more than one certainly can. And when we look at the debt of the world, yes, we have to be concerned, she says. During COVID, what did we do? Everywhere governments borrowed, rightfully so, to help their people. And so as the IMF talks about slowing global growth, one of the issues coming up in the years to come is going to be how governments are going to respond to the next recession. I'm saying they're not going to have the ability to because of all the debt, and that's going to be a problem, because if you see a major power start to have struggle with their debt, watch out below. Everything else beneath is going under. And how do you describe the state of U.S. economics and politics? And Georgieva says the U.S. economy is remarkably resilient, although I'm not sure I agree with that. Is we expect 1/3 of the world economy, get this, to be in a recession. And yes, as you said, even countries that are not in recession, it would feel like a recession for hundreds of millions of people. But if that resilience of the labor market in the U.S. holds, well, not a chance. How about this? We go back to that 10-year, 3-month yield curve in red, now overlaying the 4-week moving average of initial claims. And what do we know? Where the yield curve bottoms and then moves higher, look at this. Claims start to rise. Again, claims are rising just slightly ahead of the yield curve steepening. Again, curve steepening, claims start to rise. Curve steepening, claims rise. And here you go. We haven't seen the curve start to steepen, but watch out. When it does, we know that claims will soon follow. And the final macro data point at 22 just printed. It was better than expected as we now look into the U.S. with the Chicago PMI bouncing from 37.2, which is a steep contraction, to still in contraction at 44.9, but much better, but remaining in deep contraction. Here you can see the chart. Now, notably, this would be a good sign as we come off a bottom, perhaps indicating that the U.S. already has gone through a mild recession and is starting to recover. The risk, though, you can see in the past, if we do get some of recovery and then it comes crashing back down, well, then we've got serious problems. So we'll be watching this over the next couple of months to see, does the U.S. economy start to show signs of recovery? Because if not, this may be just the first direction it goes. We could look at a massive slowdown coming later this year. And under the hood, we see the headline index of the Chicago PMI. The prices paid rose at a slower rate, meaning inflation is slowing. New orders fell at a slower pace, signaling contraction for where new orders go. Prices paid will follow. So as new order demand goes, prices come down. Employment fell at a faster pace. Of course, all eyes will be on employment over the next few months, especially with the Fed. And inventories fell. Again, there's a sign, inflation coming down. Supplier deliveries rose, inflation coming down. Production fell at a slower pace, inflation coming down. Economy slowing. And so all we see here are signs and more signs that if Georgieva is right and 1/3 of all countries are going to be in a recession this year, the actual prediction is that number is going to be much higher. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.